So, what is money and risk management? Risk management means recognizing and reducing possible risks, while money management emphasizes properly allocating and safeguarding trading capital. Both aim at the same goal, which is securing long-term success by protecting capital and maximizing profitability. Let's start with a simple introduction. But before we move on, if you find this content useful, be sure to press the like button. Oh, and remember, subscribing costs nothing, but the strategies I provide may prove invaluable. I'll meet you right after the intro and disclaimer. Now picture the market trending upward. We identify a support level and a reversal candlestick setup. So, we enter long at the close of the engulfing candle, place our stop loss beneath the doji, and aim for twice the risk as our target. Suppose our account balance is $1,000. The position size defines what fraction of capital we lose if the stop loss gets triggered. If we risk 5% of our account on this trade and it fails, we lose $50. Even if we win just 1 out of 3 trades, we end up breaking even. That doesn't sound too bad, does it? But imagine losing 5 trades consecutively in a rough trading week, which is something every trader faces. That would mean losing 25% of our capital within a week, and you can imagine how damaging and frustrating that can be for future trading decisions. Blowing an account doesn't mean losing all your funds. Once half your capital is gone, the mental impact alone can finish you. This is exactly where money management plays its role. If we risk 2% of the account on each trade, 5 consecutive losses only reduce capital by 10%, which can easily be recovered during profitable sessions. Later in this video, I'll share some powerful money management methods to boost returns. But for now, let's get back to risk management. How does risk management assist us in this trading case? Think of it this way: after buying this pair, the price moves against us. With a downside break and close, we can anticipate further decline and possibly a stop hit, even before the stop loss is touched, by closing half the position early. We save 25% of the intended risk on this losing trade. On the flip side, when the market moves in our favor, there's always the chance of reversal, causing a winning trade to turn into a loss. Locking in partial profits before reaching the ultimate target is another valid risk management method. In essence, risk management revolves around detecting and reducing the risks of potential future outcomes. Now, let's move forward with some of the fundamental rules, concepts, and calculations of money and capital management. How much should you risk on each trade? The answer mainly depends on your personal risk tolerance. Risk tolerance refers to the portion of money you can comfortably afford to lose when facing the inevitable losing trades. We define risk tolerance per trade as well as in total capital. Ask yourself this: what percentage of your account are you willing to risk per position, and still remain comfortable if the trade doesn't go as planned? Secondly, if you hit a rough patch and lose 5 trades in a row, what percentage drawdown on your account won't let emotions interfere with your upcoming trading decisions? Based on these answers, you can build a strong money management framework, and sticking to it keeps emotions out of trading. If you stake more than you're prepared to lose on a given trade, your emotions will end up dictating the outcome. For instance, risking 3% of your initial balance per trade means 5 losing trades in succession will cut your capital by 15%. But why not risk very tiny percentages instead? That's because the percentage risked on each position also determines potential gains. For example, if you trade a small account and risk just 1% per position with a 1-to-1 risk-to-reward ratio, you'll only earn 1% per trade. After all the effort you put into trading, such small gains may not feel worth it, leading to discouragement. Therefore, your money management approach should ensure that winning trades motivate you to continue, while losing trades don't force you to quit. If I were a beginner managing a small account, I'd likely risk around 2 to 3% of my balance per position. Now, let's see how to calculate our position size while trading different currency pairs. Calculating position size relies on 3 factors: the percentage you're willing to risk, the size of your account, and the stop-loss distance in pips. The concepts of money management we covered earlier focused on survival and protecting capital. But what about growing it? When you are on a winning streak, One safe method to accelerate growth without letting emotions interfere is by transferring a portion of your profits into a separate account. After securing large wins, you can use that second account to risk more than usual and test how much growth you can achieve. This way, you're only risking profits, which makes it much easier to control emotions. Additionally, it's important to withdraw part of your profits each month and use them for personal spending, as this motivates you to keep progressing in this long trading journey. If your plan is to grow the account continuously for years without ever withdrawing, chances are you'll eventually face burnout and lose momentum along the way. Now that we've covered money management concepts, let's move on to some risk management techniques and ways to handle open positions to maximize profits. We'll begin with the most basic method, which is setting trades to break even. Imagine an uptrend with a sequence of higher highs and higher lows, and we want to trade in line with the dominant trend. We enter long and place the stop loss beneath the recent swing low. The target is set at a higher time frame key level, which could act as a potential turning point for price. This setup provides a 1-to-5 risk to reward ratio. But maybe you've experienced this before. After being in profits, the market reverses and hits your stop, converting a winning trade into a loss. Or perhaps you closed early for a small profit, only to see the market eventually hit your long-term target. To prevent such situations, traders apply a simple method: moving trades to break even to remove pressure. Once price moves 2 times the distance of your stop loss, close half the position in profit. Alternatively, you can split the trade into 2 entries, each at half your usual risk, and set one of them to a 1-to-2 target. That way, once the first target is reached, even if price reverses and stops you out, you end up at break even without losing capital. From there, you can allow the second trade to run stress-free, waiting for the market to hit your larger target or closing it earlier if needed, for example, ahead of high-impact news events that could cause slippage, or at the end of the trading week. Now let's move on to the second technique. In this approach, we trail profits until they reach the higher time frame key level, which gives us the chance to capture extremely high risk to reward trades. In a bullish scenario, after entering a long position, each time the market breaks structure to the upside, we shift our stop a few pips below the newly formed swing low. This way, profits can continue running until price either reaches the higher time frame key level or forms a reversal. Let's look at a live example on the EUR/USD 5-minute chart. Here, the price tapped into a major structure level, which could serve as a turning point for the ongoing downtrend. The only confirmation we need to go long is this double bottom chart pattern, signaling a possible reversal ahead. We place our stop beneath the swing low and target the next key level visible on the higher time frame. From there, we let the trade run, and with every break of structure to the upside, we trail our stop just under the latest swing low. This allows us to lock in profits and secure large risk to reward trades without worrying about giving gains back. These are just a few examples of money and risk management strategies that you can adapt to fit your trading style. That's it, traders. Thanks for watching. I hope you found value in this video. If you did, make sure to hit the like button to show your support. And if you're new here, consider subscribing to the channel. See you in the next episode.